Training Justice Podcast 596 here with my brother Matt Justice. This is Mark Justice. Going to talk about some Fed today. We're going to talk about some technicals, going to talk about some gold. Very jam-packed episode we have for you today. A lot of analysis setting into a big week. Before we get started, I want to promote two things. One, I want to promote an upcoming Master Trader event we're having at Tackle Trading. Technical analysis is amazing. We're going to talk about Matt's tremendous technical call here in a few moments, but technical analysis is amazing. You need a foundation to trade these markets. Technical analysis plays a bigger and bigger role in markets. That foundation is what we provide in this Master Trader event. It is this coming Monday, not this week, but the week after, the 23rd and the 24th. So it's a 2-day event, a couple hours each day. We'll lay that foundation for you. It is for our pro members. It is a tremendous time that if you've been thinking about joining this community, signing up for a free trial, this is a way to get into that class. Sign up for that trial. Go to tackletrading.com. Matt, just give us a little preview of this class. It's just such a great class for new and intermediate traders.
Yeah, we teach it once a month for our pro membership, and it's a wonderful 2-day class. If you're looking for a professional, amazing class to kickstart your education, Master Trader is where you want to start. Day 1, we talk about technical analysis. Day 2, we get into cash flowing in the options market, trading options from a directional perspective, and it's chock full of great education. Once again, it's free for our pro membership, so if you are interested in an amazing course that you can really kind of kickstart learning technical analysis and trading options, there's not a better place to do that than Master Trader at Tackle Trading. And once again, it's a week from Monday, this coming Monday, so about 8 days from right now as we're recording this on a Sunday, and we're gonna have a lot of fun in Master Trader as we do every single month. And once again, free for the pro members. So all you got to do is sign up for a pro membership and then get registered for Master Trader and have some fun.
Yeah, the other thing I like to promote is our newsletter. We have a new newsletter out. If you sign up for that free trial, you get that Tackle Trading newsletter, which is just a fantastic way. If you are not involved in the markets every day or don't live them 24/7 like we do, this is a fantastic way to understand all of the major elements that are facing the market. And had you read that newsletter last week, you would have seen a tremendous technical call from my brother Matt. We rank each sector, we rank all the commodities in that newsletter, we rank the market itself. And if you remember last week, there was a lot of selling pressure. It was a nasty week into the market as we headed into the start of the week. Down candle, couple dojis, down candle, real selling pressure. But we did not downgrade the market, Matt. That call by you, your analysis, and it was not this, oh my gosh, we're going to V-shape here, but it was like, there's no reason from a technical perspective to downgrade this market yet. That I have more money in my account because of your technical analysis than I would have otherwise. Because I'll tell you what, I appreciate that.
I know it's a real statement. I talk to you all the time.
Because when I saw intraday price action that was constructive for bulls, particularly on Wednesday, when you were coming off support, because this was something, I flipped the script. And on Wednesday and Thursday, I did a lot of things based on intraday price action that flipped bearish trades to bullish trades in the week. Because of that technical call, you should pat yourself on the back. I'll pat it twice for you. Buy the favorite Starbucks drink of your choice the next time we run into each other. But talk about that technical call and then lead into where we are this week from a technical perspective.
Well, to talk about the technical condition, you have to talk about not just last week and the 540 level holding last week, but you got to go back to the week before and the volatility of the week before and how you see that and how you break that down, because there's a lot of different ways to look at the market when it is showing increasing volatility, when you are giving up a little bit of the momentum, and when you do break some important moving averages. And so it was a difficult conversation, quite frankly, with a lot of the coaches when we were talking about whether or not to downgrade the market last week. And at the end of the day, Mark, I just made an argument, and my argument was really, really simple. When we were going into the 565 breakout the first time after the V-shaped recovery, you were overextended in that condition. And when you're overextended going into a breakout, you're going to see it two ways. You're going to get ready for the breakout, or number two, you're going to get ready for the pullback. And when the pullback does occur, oftentimes people are going to get a little bit concerned in that environment because you're shifting momentum in that environment. And that's what you're really kind of breaking down, is the momentum of the condition. And so what the argument I made basically was, at the end of the day, regardless of how we are discussing the two big down days in the market over the last couple of weeks, one that violated the 9 EMA, thus increasing a little bit of the bearish momentum, violating the 9 EMA in that condition, and then ultimately on the labor market data where you violated the 50-period moving average. I saw those movements, quite frankly, more algorithm centric than really anything else, as we're having that conversation over the 0.25 or the 0.50 interest rate cut. Algorithms are very keen on that conversation. And then secondarily, when you're pulling back and you're going through a bullish retracement or a pullback in the market, they're a little bit more concerning than breakouts, because breakouts are extremely clean. But when you go through a pullback, you don't get overtly concerned simply because you give up certain levels in the pullback. Remember, in pullback analysis, you can pull back over 60% of the previous upward movement in price and still see that as a bullish type situation. And so what I was looking at last week when I made the argument to not downgrade and keep our ranking right there at the slightly bullish ranking at
yeah, and I would just like to just point out, if you listen to this podcast last week, we titled it "A Bump in the Road," and Matt laid out his whole case why that was the case.
And it really was the 38 to 50% pullback, which I categorize as the Goldilocks retracement. And then secondarily, you were sitting at a massively important level of support right on the weekly chart at 540, which is a defensive zone for the marketplace. You got to understand the market. The market can do anything on an intraday perspective, but when you're talking about the market from a longer term perspective, there's some really interesting defensive zones here, and 540 is one of those defensive zones. Because if you give up 540, if the buyers don't step in at 540, they're not stepping in until 510. And so as you broke 555, you quick journey to 550. When you broke 550, quick journey to 540. And if you were to break 540, it was a vastly different conversation than if you held 540. So I just felt like the buyers were going to defend that area. I felt like we were navigating a little bit of a pullback. And at the end of the day, I felt like we were going to be talking about a cup and handle. And so that's kind of how it played out. But at the end of the day, it was a technical call more than anything.
Yeah, no, and that technical call was really tremendous, and it was logical. I listened to it because, listen, I'm a human being. I'm a human being with emotions. We were coming into last week with some heavy price action, and as you said, if you broke these levels, it was a bit before the next, right? But we didn't break those levels. And then when we didn't break those levels and saw the intraday price action, well, it took off from there.
And I just want to bring up one point on that, because the 540 level holding last, Monday, Tuesday with those upward moves in price was one thing. But it wasn't until the algorithm response post CPI report on Wednesday that you really saw that double bottom at 540 confirm. And then we were breaking it down for our pro members live on Wednesday, literally after the CPI report. And we were talking about intraday, what you specifically need to see happen. And once you got back up above 550 mark, you just saw algorithms take control. You saw the buyers start stepping in. And then it was just, honestly, when these things occur, there's a magnet in the market. And that magnet is right back up at resistance.
Yeah, you talk about this concept all the time. Yeah. When you get in between zones,
once you achieve something on the intraday level, it's
like let's go find that next zone, and then we can have another conversation, right? Which is
well, and now that has occurred, you're right back up into resistance, and this is going to be a very, very compelling week, both from a fundamental perspective as well as a technical perspective, because obviously on deck here, Chucky, we got the central bank on deck, and they come in on Wednesday. So on Monday, And by the way, there's not a lot in earnings this week. There's not a lot in geopolitical. This is really going to be centered around the central bank this week. The only economic report you got before the central bank of any degree of importance is core retail sales. After core retail sales, you get right into the central bank. And so you're going to get a little bit of algorithm volatility on retail sales, but I that's really the only news story of importance.
Yeah.
Or you get into the central bank on Wednesday.
Yeah, and we're going to loop back around. We're going to loop back around to a couple things. We're going to loop back around to some other charts that I want to discuss after the Fed, and then obviously we're going to take the Fed itself. But just from a broad market perspective, S&P only. Let's not consider tech, small caps. We're going to come back to those here in a second. Just from an S&P perspective, where are we heading into the Fed?
Well, I think SPY, RSP, QQQ, however you see those three indexes specifically, you're really talking about a very similar type situation. The markets, following CPI report, the markets are running on the same gasoline, and I really don't expect separation until the central bank, because the only thing on deck that's going to separate the market is the differences between 0.25 and 0.50, which, quite frankly, we're not going to know for certain. Outside of Nick Timmerose kind of hinting to one, we're not going to know for certain until we see what the Fed does on Wednesday itself. And so when you're looking at the spiders, obviously we're going to be talking about a potential breakout this week. We're navigating the 565 level on the spiders themselves. I think the ideal technical setup going into perhaps a multiple time frame breakout, it's a cup and handle on the daily chart, a little bit of a cup and handle on the weekly chart. So you're talking continuation technical analysis here, and continuation patterns are really, really, really powerful. They're the beginning point of trending analysis, quite frankly. And so if you do get a breakout this week, the best type of breakout that you will see that possibly has legs here is if you can consolidate going into the Fed and then break out post-Fed on a positive catalyst. Obviously, we do not know how the market is going to respond to what the Fed does on Wednesday. We don't know how Jay Powell's going to paint the Fed on Wednesday. But what I do know is the ideal technical setup is 2 days of consolidation following some volatility, which you're going to get on Wednesday, followed by a confirmation breakout on Thursday. If you look, if by the end of this week, we are talking about a confirmation breakout of 565, you got what you wanted out of the central bank this week.
Yeah, and listen, we're going to do some stock in the news. We've been doing 5 stocks. I bring 5 stocks that interested me. Matt talks about them. I'm only going to bring 2 this week. Fed's going to take some of our oxygen in this podcast. We're going to bring 2. I want to talk about Academy Sports. Another chart that made me money this week was discretionary sector as a whole. And then the price action on Academy Sports earlier this week. A couple things. On discretionary, this chart had several chances to sell off, didn't want to. That I made note of that during the week. We talked about this on the lounge a couple times. Mm-hmm. Academy Sports had a negative earnings report. You're going to tell us the numbers here. They had a negative earnings report, did not want to sell. Now, it would be one. Academy Sports is a well-known stock at tackle trading. It's not necessarily a well-known stock for the market. It is something Matt put on the tackle 25 a few years ago as a fundamental darling. It's performed very well. Retail stocks, we have seen retail stocks get hammered more than not. And certainly when they've had an excuse to get hammered, Academy Sports was in that situation, did the opposite. Talk about very interesting price action on Academy Sports.
Well, early in the week, and we talked about this quite a bit in the lounge, because it was a massive change on the behavioral side of how companies in the retail space respond from an earnings perspective. The week before, we had seen multiple different companies that came in with negative earnings reports in the retail space, gap down, sell down on lowering of guidance is basically what was seen. Retail itself is holding through, but retail itself is an index. You have some good stocks, you have some bad stocks, you got a lot of stocks in between. But what we saw in Academy Sports, which is a Tackle 25 stock, and you're absolutely right, Mark, it's not a very popular stock broad base, but it is a stock to keep your eye on, because when it moves, it has a tendency to move fairly aggressively. I was anticipating a gap down based on their numbers because they missed on EPS, missed on revenue, and then on the guidance side of the equation, they had a very big wide range on guidance, and I think you could argue a lowering of guidance there. And the market did gap down slightly before it recovered very aggressively. And that was in front of the CPI day. That was in front of what we saw the price response on CPI. Remember, this was Tuesday morning coming into the market, and the market was still on pins and needles from last week's volatility. And on Tuesday morning, we saw Oracle on Monday, we saw ASO on Tuesday. ASO was just the behavioral change. And that after that, Mark, you just started seeing the market interpret the data coming into the market with a little bit differently than it was the week before. And so that was a pretty big catalyst for us to tackle when we did see that on Tuesday. And it certainly did change the way we were breaking down the rest of the market the rest of the week.
Yeah, it was. Second stock will not be a surprise.
Keep ASO
Nvidia,
on to watch this, by the way. They got a mid-tier breakout situation.
Give me Nvidia. Nvidia, one of the things that helped spur some of the robustness we saw Wednesday onward. CEO of Nvidia comes out on Wednesday, says, "Hey, lots of people." I'm gonna paraphrase very loosely here.
Yeah,
lots of people still want our stuff, people. Like lots of people still want our stuff. And we're doing the best we can from a customer service perspective because demand is off the charts, right?
pretty much.
Yeah, pretty much, to paraphrase what he was saying. Naturally, Nvidia had, if you needed any evidence of the importance of Nvidia to the market, here's a little did you know stats. Did you know that 44% of the S&P's gain on Wednesday was Nvidia? Like Nvidia itself, 44% of the S&P 500's gain. But you cannot understate the sentiment effect. We've seen this for 2 straight years. We have seen times where the market was choppy, the market was this, the market was that. Nvidia gets a spurt and lots of broad shoulders on that general's, on those general shoulders lifting the market. Now, Nvidia has a very interesting technical setup itself. Couple doji candles here, break out of a high base would be a pretty classic pattern heading into that triangle. Talk about Nvidia, talk about the technicals here.
Yeah, it was good to see Nvidia come out with the buyers, and once they stepped in, obviously the Qs and the semiconductors themselves had a little bit of a reprieve, and I would say an improving condition, but you're still underperforming what we're seeing in the broad market itself, especially on the Nvidia technical pattern, and just for example, you look at the Qs here, and when you're looking at the Qs, you're up at the top end of the symmetrical triangle that you're looking at in the Qs. A little bit of consolidation here, breakout. You would probably see some catch up on the Qs versus what the SPY has done. So the Qs themselves are actually in a slightly better position technically than Nvidia is. But I also see them running very a lot on the same gasoline right now. SMH a little bit similar to what we're seeing on Nvidia itself. SMH underperforming a little bit of what we're seeing in the Qs itself. But these are areas of the market, meaning semiconductors, Nvidia, that can play catch up very aggressively, as we all know. And so, like I said initially, Mark, when we were talking about the indexes, I'm not sure, depending on how you see the Qs, if you're looking at Q components or if you're looking at spider components, you're looking at cyclical, the markets are really running on the same gasoline right now because we're having a macro conversation in front of the central bank. I don't think we're going to see separation on the index side until we get post central bank, because there's no catalyst out there that would provide the reason for the market to start separating here. And so my recommendation in the newsletter, and definitely for the pro members, check that out. And if you're not a pro member, you definitely want to be reading the newsletter. It will help you understand what's happening in the market better than almost any other newsletter out there. We provide a tremendous amount of detail. Not only do we do 5 different articles in the newsletter, from technical analysis to earnings to sectors to global markets to an economic update, but we also do 3 videos in the newsletter to provide all the very detailed analysis that you need to have an understanding of exactly what you're navigating from an index perspective. And my general read in the indexes was, yeah, different patterns. different, like for example, the Qs, SMH, Nvidia, they're all in symmetrical triangle type situations. Whereas when you're looking at the spiders, when you're looking at RSP, for example, they're in a little bit of a better, more strength, momentum, continuation pattern type perspective. But you're kind of running on the same gasoline. I've said that about 6 times right now, because that's what occurred following the CPI. And now with the Qs, you're right back up into resistance. It's a symmetrical triangle resistance level, but it's a resistance level nonetheless. You're at a horizontal resistance level in the spiders. And so I kind of see this the same way. A little bit of consolidation will go a long way. But one last point on this potential breakout here that we're navigating this week, and I think this is extremely important. Unlike the V-shaped recovery we had just recently, this area of this movement we're seeing in the market over the last 3-4 trading sessions coming into those same levels of resistance, they're coming from a higher level of support. And so you're not nearly as overextended going into the potential breakout this time around as you were just a few weeks ago. For example, Mark, again, when you think about the distance you run going into a breakout, markets get tired, traders get tired, participants get tired, and you certainly don't want to be chasing momentum. And so when you went last time in the Qs, you went from 425 all the way up to 485 before you were getting into a potential breakout type situation. The market's overextended. It's tired going into that breakout. You're going to want to see that get digested. Now, maybe not all the way back down into a symmetrical triangle, but you still want to see that get digested. Now you're running from 450 into a 475 breakout. You're not nearly as exhausted in that situation. When you look at the spiders, for example, you say, okay, last time we ran from 410 all the way to 465. The market's really, really tired in that condition. You're going to want to see a secondary pattern. You don't know the specific pattern you're going to see. That's why it was important to break it down from a technical perspective. Now you're running from 540 into that exact same breakout level at 565. You're not nearly as tired in that situation. And then when you look at your traditional indicators like RSI, for example, on the spiders, the last time we were talking about the 565 breakout, RSI was upwards in the mid 80s mark, with the top shelf on RSI right around low 90s. That's not a lot of room there to run. Now you're talking about RSI at 50 with the positive slope going into a potential breakout. That would be a textbook confirmation, quite frankly. When you're looking at MACD here, MACD is crossing here literally on Friday, going into a breakout situation. That looks pretty decent as well. And so again, the indicators don't say gobble up and buy. What they do suggest is that if we do get a breakout, we're not overextended going.
Yeah, they're not an impediment, though, to bullish plays, basically.
Which, quite frankly, it's September, and we have not had a lot of moments this year where we were not overextended going into a breakout. And so, Mark, we're not overextended going into a breakout, and we're starting to get into mid-September. And quite frankly, that's when we start to see the volatility start to decline in September seasonality. And so I think the market is in a pretty good position here going into a potential breakout. And so let's just all say this, Fed, don't mess this one up.
Yeah, and we're talking about the Fed here in a second. Let's go over to the gold, Matt. A different time when we didn't have Fed and so many things to discuss about. We would have led the podcast and talked for 35 minutes on gold. We do not have time to talk 35 minutes on gold. We got time to spend a couple minutes on gold, though. Classic breakout. Gold is one of those things in the podcast. If you were listening to the podcast for the first time, we have been making the case for gold for since we started the podcast years and years and years ago. Yeah, like so. And we have been talking all year long about the behavioral characteristics on the chart. Gold does not want to sell off. Had many excuses, never wanted. Not a surprise that we are now on the weekend, heading into the week, dealing with a breakout all-time high scenarios. We'll talk about the fundamental case for gold another day, Matt. But just from a technical perspective, talk about secondary pattern watch, how to handle this situation.
Well, obviously, it goes without saying two things. Number one, this breakout is legitimately a good breakout. That's number one. Number two is you're going to expect volatility post central bank. You just are. And if you get a 0.50 cut, that volatility could be to the top side here, because I do think that's playing a little bit of a role in this breakout here on gold. I'll just reiterate what I said 2 weeks ago in the newsletter, Mark, when I wrote about or was it 3 weeks ago when I wrote about gold and the probability of gold versus the SPY going into rate cutting cycles. And the SPY really depends on how we as a society see the economic environment in a rate cutting cycle, is where which means the economic conversation over the next 3 to 6 months becomes chiefly important. Will we not have a soft landing? Will we not go into a recession? Those are open questions that we're going to have to navigate. And quite frankly, the SPY at the end of the day, how the market responds into the if a year from now, for example, with these rate cutting conversations, it's going to be dependent on how the economy handles those rate cuts. The probability of upward movement of price is legitimately a coin flip when you look at it historically. When you look at the same environments, rate cutting cycles historically since 1980, you really haven't had, you're batting 6 out of 6, quite frankly, in rate cutting cycles on gold analysis. In pausing cycles, in rate cutting cycles, gold has an edge. In increasing interest rate environments, gold usually doesn't have an edge. The weird thing this time around on that side of the equation is we were dealing with inflation that was reminding people of the 1970s. And so gold has just been a wonderful asset class. At Tackle Trading, I was in the lounge the other day and I asked a question. What is the most confident you have on any asset class in the marketplace? And I would say 90% of our community said gold, 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 gold. And because it plays such an important role in a portfolio from a protection mechanism perspective. It gives you that peace of mind for everybody else that worries about the long-term retirement account. Obviously that's understandable. But when you do have a gold position, you're hedged against some of that economic potential calamity. And so it's a lot of peace of mind. Number one, I think that's like number 3. I could go on like number 4, 5, 6, 7, 8, 9, 10 here, but you got to be looking at gold here, Mark. Any snapback retracement to the 9 EMA would be a really, really good pickup zone when you're looking at GDX. And I do think this is where the interesting conversation actually in gold occurs, because I don't find gold's latest good breakout to be fascinating, quite frankly. We see a lot of
expected,
and it was expected.
It telegraphed itself very well.
Very, very well. But GDX here, I just find that anything above 40 is going to be very, very, very compelling. A lot of gold stocks have underperformed long-term situations. And when you're looking at the 40 handle, this is one of those areas that we haven't really got back up above on GDX since we had a parabolic breakout that got snuffed back in 2019. But outside of that, Mark, we haven't tested GDX components above 40 cents all the way back since, when was it? On the breakout above was all the way back in 2009, 2010. These are compelling opportunities, because what we do know about gold stocks right now is they're making a lot of money with where gold itself is right now. But gold stocks get held back because of market mechanics. Gold stocks get held back because, quite frankly, Wall Street doesn't love gold and it doesn't love gold stocks, but they should. If they start breaking out of 40, I do think you're going to see some momentum here. And I do think you got better analysis going into the breakout of 40 this time than quite frankly, you've had at any point since the breakout initially, all the way back 15 years ago. And so I just think gold stocks got to be on the radar, and more from an aggressive perspective, because they can move, and they can move very, very, very aggressively. And so I just think gold, again, any development here at 40, any breakout here at 40, I think you got to be looking at any pullback scenario on gold, because gold stocks, you want to talk about momentum? Gold stocks have better momentum over the last 3 days than almost any other instrument out there. You want to talk about Nvidia doing great on Wednesday? They didn't hold a candle in the wind to the candle on gold stocks on Thursday. You got some momentum here. Let's see what we can get above 40 here.
Yeah, no, let's fire through the rest of the commodities, and then we're going to get into the Fed real quick. Some tailwinds on silver here. I knew you were going to immediately go to silver. And we've talked about this on the lounge. We're going to have a more detailed conversation on this in next week's podcast in looking at perhaps the historical moves. But when you look back at the major moves gold has had over the last 15 years, right? And there is no doubt that this is the third major move over the last 7-8 months that we've had in gold in this thing. Silver has participated in all those moves. And there have been large stretches in those where silver has outperformed from a percentage gain. I know we both think that that's exactly what's happening right now. Some serious tailwinds to silver. And I made this comment in the lounge, Matt, that the technicals on silver are going to be the technicals on silver, but the technicals on gold are also the technicals on silver. And talk about that for a second.
Trending environments.
Yeah.
In a trending environment where gold and silver are both trending, silver does have a historical tendency to outperform gold. And on the breakout of gold, we are seeing the last 2 days outperformance on silver. You got back up above 30. You're now at 31. You're kind of at the overhead trend line on silver here. I just think if we are getting a leg in gold, we're going to see something above 32, 33 on silver in my estimation. And if that's the case, any secondary pattern here plays. I talked about all week long in the lounge, Mark, all week long. I think I mentioned it literally every single day in the lounge this week. I just love the 28 handle. I just love the 28 handle on silver. It held firm all week long. And then on Thursday, you got liftoff there. And a lot of people probably missed that silver situation because it did go fairly aggressively, which means, do you want to chase? Probably not. But do you want to be focusing on silver for any secondary pattern, any high base, next pullback scenario? Absolutely. And that's the thing about breakouts and momentum. Oftentimes you see it and you're like, oh, I wish I would have been in that lounge talking about how awesome 28 was. Well, you can't go back and be in that lounge if you weren't. What you can do is break it down right now and talk about what you need to see right now so that you can be prepared for that next great move in silver or whatever the case might be. If this is a trend, Mark, we're going to get another secondary pattern. You just are. You always do.
Do.
If you missed it, don't chase it. That's just the recommendation we always have at Tackle Trading. We're not the bar by bar momentum YOLO people that social media loves to have in quite frankly, all things technical analysis. But I would put it on the radar for any secondary pattern. It looks pretty good.
Give me 30 seconds each on copper, oil, and Bitcoin from a technical perspective.
Copper's in at a position where you could definitely see some development. You got to like the overall reversal type situation here. This is more of a traditional reversal that is happening on the daily chart. The weekly chart is really holding firm against the 200 weekly moving average. The question ultimately is, what do you need to see on copper, and specifically, therefore, what would you need to see on companies like FCX or Southern Copper, for example? Breakout. And quite frankly, a pullback after the breakout. There's some volatility in some of those copper stocks right now.
Oil and Bitcoin?
Oil, my opinion of oil. This is a dead instrument for me unless we get a W formation. I do not like the volatility of the space. I do not like the uncertainty of the space. It has not run on any. It's ran opposite the way you think it would behave in the environment that we are in. It's just been all over the board. What do you need to see? Number one, 66 does have some pretty important historical levels to it. Number two, you are tracking a bear flag right now, which would put the probability of a double bottom here fairly aggressively. Number three, you got to let time play out here. I cannot say that more. I have no desire to V-shape crude oil right now. And so if you get a W here and you let those shorter duration moving averages converge against a breakout, then we have something, but that's down the road.
And Bitcoin, go to church for 30 seconds. We are recording this on a Sunday after all.
Bitcoin going to church on a Sunday, improving, but definitely needs to improve a little bit more. Open question. I've been having this open question in my own head recently. Is 50 to 55 100K the new floor in Bitcoin, whereas, you know, historically, when you look at Bitcoin, you do look at those historically right around 25 to 30,000 as the floor. Are we seeing the development of a new floor historically, the way we do see on commodities over time? For example, 100 years ago, the average price of crude oil was not $65, for example. It was $10. I'm just making that up, but you get my point. So are we seeing that occur here? I don't know. I'd have to see a little bit more, but at the end of the day, support is holding. We haven't broke out of any resistance level in a long time with any sustainability. So you're going to need to see more development.
All right, let's get to the question that the markets are grappling with as we face the week to finish off the podcast. Spend some time with this. So the CPI report, the PPI report, the inflationary data, jobless claims, they all came out this week and they painted a picture of, okay, little uptick in inflation, right? Little uptick in inflation, something to make a note of, not to act upon today, but one of those, all right, make a note. If we get some more of these down the road, then we're going to have an inflation podcast or three. All right, we're going to have an inflation podcast or three, but for now, make a note. And unemployment claims kind of got locked into the same range it's been. And FOMC rate cut odds at one point during this week dropped as low as about 11%, that we would only get a 50 basis point cut as opposed to a 25 basis point cut. In market terms, 25 basis points seemed locked in at this Fed meeting the next week. Seemed locked in. That's not where we ended the week, however. We ended the week in a coin flip scenario where you are now at about a 50-50. Do we get a 50 basis point cut?
50. It's weird.
Or a 25 basis point. Now, the reason these odds have surged for 50 basis points, and this is pretty much accepted by Wall Street, Nick WikiLeaks Timiraos from the Wall Street Journal, known as the Fed Whisperer, and he has this title because he is a known disseminator of information when the Fed is in their blackout
gives
period.
him information that he wants to spread to the market in front of events. Yes.
Yes. Market knows that this is his role in the market.
Yes.
Now, the Fed, if you don't know what a blackout period is, for a time period heading into a Fed meeting, Fed officials do us all the favor and they don't speak to us, right? Instead of giving us 47 speeches in a week, they don't give us any. They don't talk to the press. They don't do events at Columbia University. They don't do panels with the ECB. They do not communicate with the market. And as we were in the week before the Fed meeting, they were in that blackout period this week. Now, Nick wrote an article in the Wall Street Journal, and I read every word of this article, Matt, and he was laying out the case why the Fed might go 25 basis points or why the Fed might go 50 basis points. And the article spent a lot more time why they might go 50 basis points than why they might go 25 basis points. My favorite part of the whole article was Esther George was the one single quote on why you might go 25. Now, and they had several people quoting and giving reasons on the 50.
And not only was there rationale for the 50.
And I'll get to that in a second. I just got to get to the thing I found the most humorous. But then Esther George, who was the only quote on the 25 basis point, also said, was used as a quote to be like, yeah, but I could get talked into a 50 basis point very easily. Right? So it was a very slanted argument. Obviously, that was not just my interpretation of the article. Obviously, the markets picked up on this and basically said, okay, we're going to give Nick the respect the Fed Whisperer deserves, because this might be Powell telling the market what Powell wants to prepare the market for, right? So a 50 basis point doesn't surprise the market. And here we are at a 50-50 heading into the Fed meeting. The rationale in the article was what you would assume the rationale. The labor market was deteriorating. Hey, they did supersized hikes on the way up. What would, it'd be consistent to do a larger cut on the way down if now was the time.
If they're cutting, though, 0.50, if the argument is we're going to cut 0.50 because of weakness in labor, that tells me their internals are worse than the reports themselves. And I would personally see that as a sign of weakness and not a sign of strength, if that is the reason they cut 0.50. Now, the market right now might just be hearing 0.50 and they're, that's positive for the algorithms right now. But over time, I'm sorry, the data is very compelling to me that if the rationale of the cutting cycle is the concern of the economy, and they're going to be more aggressive in the cutting cycle because of the concern of the economy, I'm telling you right now, the Fed has internal data that is more concerning than the market currently has. And you don't need to go too far in history to understand that. You can go back to 2019, you can go back to 2008, 2007, when the Fed was talking about their cutting cycle back in 2007 and 2008, and the Fed came out started cutting in mid 07, but in early 08 there was a moment where there was a debate regarding the health of the economy, and the Fed tried to paint the economy as strong while they were cutting, and the economic data kept going down, creating more and more and more volatility as the Fed was obviously trying to gaslight the economy. And so to me, again, I bank a lot of my analysis on the historical understanding of how the market behaves in these environments. And I have a tendency to think that's a negative to the market. If the Fed is going to cut rates based on economic weakness, and they're going to have to be more aggressive in that cutting cycle early on, it's again, they're seeing some data that they're not showing the market. You can cut 0.50 here and be perfectly fine, but the argument has to be you're alleviating the restrictive territory of the interest rate. Right now, you got year over year CPI report at 2.5%. I think core is right around 3.1, 3.2%. So right now, the Fed has an interest rate of 5.25 to 5.50. You're restrictive in the interest rate, anything above, I would say, 3.5 right now. And so you got about a 1.75 to 2% of the interest rate that is determined to be restrictive. If you are alleviating the restrictive territory of the interest rate because you feel you've won the battle of inflation, that is a really, really positive sign for the market. And the market will be really, really, really good in that environment. But if you're cutting because of economic weakness, yeah, the market might celebrate that initially, but I think the market sells that over time. And so I just, from me to the Jay Powell, I think the messaging out of the Fed this week is chiefly important. And if the messaging is going to be based on what Nick Timiraos talked about in the Wall Street Journal on Friday, I'm sorry, I do not believe the market might buy it initially, but I don't believe the market buys it over time, because economic weakness will become the chief concern if that's the case. So Jay Powell painting this, and his message on the cutting cycle is going to be extremely important on Wednesday. If you hear the words, yeah, we're alleviating the restrictive territory, that's a really positive sign. Hey, if we're getting in front of what could be damning economic analysis, again, that could be a sign of weakness. So I just maintain the way I see it historically. The reason the Fed cuts is important. It's not just the cutting cycle. The market right now is just hearing cut, and they feel that's good enough right now. But over time, the economic conversation becomes important. So I think it's going to be very important to see how the central bank, and not Nick Timiraos, and through a couple quotes in a blackout period from the central bank, whether they are there or not. I don't think that's going to be as important as what Jay Powell legitimately says when he gets asked a question, why did you do 0.50? Why did you do 0.5? I think that's going to go a long way to see how the market responds to it.
Yeah, no, I am preparing for 50 basis point cuts. I'm on that side of the coin flip if I had to bet. I don't know if it would be a terribly large bet, but I am certainly tactically preparing for that outcome.
Again, I understand what the Fed's doing here, but I just think that's too aggressive. I think it's too aggressive to start at 0.50 when you just had concern in core and CPI. If you were in line, that's fine. But Mark, insurance in the CPI is still a concern. We're pumping up around 17.
Yeah, no, and this is why it got down to about 10% before Nick's article. Like, I mean, that was the market general.
If we don't see reprieve in shelter and insurance, we're going to be having an inflationary conversation for a long time. Those are two.
And so the market said, all
major
right, we're going to
components
10%.
of the CPI.
And then the whisperer came out and said, hey, I got something to tell you.
I get it, but it kind of, like, I can't not see what was in the CPI report. Like core CPI is not a concern right now at 3.1, 3.2, 2.5 on normal CPI. But Mark, we're talking about crude oil potential bottoming. We're talking about silver breaking out, gold breaking out, copper bottoming. We're talking about a lot of commodities that have not participated over the last 3 months, now starting to show a little bit of upward pressure in price. If the commodities start showing upward pressure in price and start trending, while we're starting to see core CPI increase, I just think that's a tough environment to say, hey, listen, we're going to cut 0.50 because we're concerned about the economy. Listen, here's what you don't want to be concerned about at the exact same time: the economy and inflation fed. And so I just think 0.50 is I think it's too aggressive in this environment. I also don't think the market needs a 0.50 to continue. So I'm going to say 0.25 because that's just kind of where my heart is. That's where my heart was all last week until Nick Timmerose came out on Friday. So I'm going to keep saying 0.25, but I wouldn't be shocked at a 0.5.
Yeah, I know. And so there's basically, to prepare yourself this week, there are going to be 2 waves of price action on intraday charts on Wednesday. So Wednesday is the Fed meeting. You're going to have the policy release statement in which we will discover whether it is a 2.5 or a 5.0, right? The policy, most of the time on Fed meetings, it is Jay Powell's press conference that gets all of the action. There's a little bit of movement. You could see some genuine, serious price action on the policy statement this time. The statement release has arguably the most important release on the statement since they started for a long time, since they were in their hiking cycle itself. And then obviously the second wave, the message he delivers, 25 basis point, Powell comes out, delivers the message, hey, we're seeing things, we don't have to rapidly cut things, things are pretty cool. Or 50 basis points, we're doing this because we're super, super confident, right?
I think that's a better message to the market, quite frankly. But like,
and I think, Matt, Powell's speech on a 50 basis point, he has a bigger sales job, doesn't he, on a 50 basis point than a 25.
He has to explain the 0.50 and why they're doing it, and he has to be specific if they do 0.50. If they do 0.25, it's again, I think he just comes out and he says, you know what, we're alleviating the restrictive territory of the inflation. We're a little bit concerned on the labor side of the equation, but with where labor is right now, where the GDP is right now, with some improving conditions on the cyclical side of the economy, we're comfortable with 0.25 alleviating the restrictive territory. I think that's an easy sell job to the market. 0.50, I think you gotta paint that, and quite frankly, regardless if it's 0.25 or 0.50, the 30 minutes after the release of this information is going to be extremely volatile in the market. It is not. We're not going to see the real move from the market until Jay Powell gives his press conference.
The 30 minutes after the market release for day traders, this is a good luck event trying to
I wouldn't even try to catch that.
Yeah, good luck trying to figure out what any of it means in that 30-minute period. It's going to be insane. And then we'll see.
And then be people making decisions. It's all algorithms.
Yeah, and so very interesting. Obviously, we're going to discuss this on the lounge. We'll discuss this in Tackle Today all week long. We'll break it down for our pro members. We'll break it down on our Tackle Today. Check out that Tackle Today. We release you kind of can think of it as a mini podcast we do each and every day, Monday through Friday. Check that out on our YouTube channel on Tackle Trading. But man, I'm very, very much interested in this week. One final thought I have, if they do 50 basis point, I do have interest in things like biotech and things that benefit from larger rate cuts a lot more
Small
you
mid
know,
caps will,
small
if it is
caps.
0.50, small and mid cap stocks outperform. ARC components, ultra growth will outperform. Obviously, we've seen those interest rate sensitive areas of the market outperform in that environment. Utilities, real estate, interest rate sensitive, they usually outperform in that environment. So I do expect separation in the market. Right now, the markets are running on the same gasoline following CPI. I think that's the case until we get into the central bank. And then I think we start to see separation.
Yeah. Give us some final thoughts as we close up our podcast, Matt.
Yeah, it's a big week this week, but again, there's not a lot of data points coming into the market this week. You got retail sales on Tuesday, you got the central bank on Wednesday, and obviously that's going to take 48 hours of oxygen from Wednesday to Thursday. Not a lot on the earnings side of the equation this week. You don't even get any major earnings until you start getting into Thursday, and so it's going to be a central bank week all week long. And at Tackle Trading, we're going to be breaking down day by day that analysis in the Traders Lounge. And the beautiful thing about the Traders Lounge, and what I love about the Traders Lounge at Tackle Trading, which we do every single morning at with our community, breaking down the entire market, doing our daily routine. The number one thing I love about the Traders Lounge is our community, our the traders in our community, the people that are learning how to do this, not just the traders, but the people going through the education side of the equation and learning how to do this, because we have a very diverse community. People starting out, active traders nonstop, is the questions and the communication and the back and forth we have with our community, answering their questions, both from an educational perspective. On Thursday, for example, when gold was skyrocketing, not gold, but gold stocks were skyrocketing, I'm willing to bet that 70% of our community were in the money on some degree of a covered call. And we spent 30 minutes literally on Thursday just breaking down how to manage an in the money covered call on gold stocks with our entire community there. And so we do that every single day in the Traders Lounge. But my last thought is, if you are starting out in terms of your interest in learning how to trade and you want to learn the art of technical analysis, like I talked about it at the first of the podcast, we do have a master trader coming up in just 8 days on September 23rd and 24th at, I believe we do it at 8 p.m. Eastern Standard Time each day. Coach Gino and myself typically teach that class, and we have a lot of fun. Last point on Master Trader. For the pro members, remember, it's not just the course. You get access to a live 2-day course just being a pro member, but we have a 6-hour on demand that you can go through this course at your own leisure, pausing, fast forwarding, rewinding, and we go through a lot of detail in that on demand as well. At Tackle Trading, we focus on education, but we believe at the end of the day, it is education plus application that is the key to success. And so if you're looking for an amazing community of like-minded investors and traders all helping each other navigate the financial world together with a little bit of an edge on technical and fundamental analysis, come over to Tackle Trading, sign up for a free 15-day trial, check out the newsletter every single week, hang out with us in the Traders Lounge every single day that the market is open, and at the end of the day, come hang out with us in Master Trader and learn how to do this the right way from a technical and a fundamental perspective. Last thoughts to you, my friend.
Now, listen, I'm just nothing to add to that. Listen, I'm excited to come hang out with us in one form or another this week, but have a fantastic week on Fed Week this week, everyone.